Okay, let's make a start then. So firstly, welcome to this session. Nice to see so many people here. It's great to have you here. We call this a series of informative events. This is the second one that we've run, and we call it that for two reasons. Firstly, we hope to do a lot of these, a series of them, and secondly, we want them to be informative, which hopefully speaks for itself. And by that I mean insightful, but also hopefully give you a taste for how we operate at Swoop and some of the people that are within the business. My name is Damon Wolf, and I'm the Chief Commercial Officer here at Swoop. I like to kind of describe myself as an ex-banker who managed to escape. And actually, Sam is also an ex-banker who I managed to pull away from banking, and he now heads up our funder marketplace. And as you can see on the screen, he likes to carry an umbrella around with him because he's a credit person. So with that, Sam, why don't you just tell us a little bit about yourself and your role at Swoop, and I guess more importantly, why should we spend some time listening to you?
Yeah, thanks for that, Damon. So my my background is with high street banks. I've worked in 3 different organisations and then moved across to Swoop last year. I spent the last 6 years working in complex credit, both in sort of SME credit and large corporate credit, and sort of you name it, I've done it really, as far as kind of transactions and size of organisations and bits and pieces. So with my credit background, where Damien can be slightly optimistic, I can certainly be slightly pessimistic in counter. So if I do err towards pessimistic, please do forgive me. But I suppose hopefully it'll give you a kind of balanced view on where we're at. So yeah, so that's me in a nutshell. I've been here for about the last year. I look after the funding panel. Basically, I oversee the relationship with all of our debt providers. But I also look at things like our quality and also the main one, things like conversion, to make sure that we are getting loans through and deals through with funders. So they're working for us as well. And yeah, I suppose, again, that's me in a nutshell. Again, I also feed into things like our tech and bits and pieces like that as well, as a bit of a credit head. So yeah.
Okay, that's perfect. Nice introduction, Sam. Well, I'm glad to have you here. As you say, I'm the glass half full person. You're the glass half empty, but it's a good combination as we go forward. Eleanor, can you just move on to the next slide, please? Because I just want to, before we start talking about the recovery loan scheme, I want to talk a little bit about like the government support that's been out there so far. And I know kind of CBILS seems to be done. The coronavirus business interruption loan scheme seems to be done, and bounce back loans. Is there anything there that is still kind of like newsworthy, Sam, or what's your kind of current view of those schemes? Is it done or dusted or?
No, so CBILS is very much still bubbling away. The lenders have until the end of May in order to issue offers and have them accepted, and then they can draw some down in June. And what we've seen, well, certainly at the end of March, most lenders that we were talking to were very confident they wouldn't need that time at all. However, what happened was the last day of CBILS, pretty much most of our lenders had a month's worth of applications in a day. And as such, they've been really struggling to kind of get through that backlog. And we saw a huge carryover of deals from the end of April into May as well. So they've been very slow to unpick that. It's caused some issues and some problems. But there's also been, because of that kind of, I suppose, unprecedented demand, there's been some real challenges with both liquidity and sort of headroom within their BBB limits. So that's the British Business Bank, who oversee the schemes. So in essence, we've got a very much of a mixed bag with lenders. Some have effectively had to decline pretty much every single application they received on the last sort of few days of March because they just didn't have liquidity. Some have now very recently started cutting the offers that they can make, so that actually they can make their kind of limits stretch a bit further. Unsurprisingly, a lot of lenders don't really want to talk about this, so it's kind of hard to eke out exactly where they are. But we're talking to them on a daily basis to make sure we understand where their liquidity is. I think that there's a key metric on there, which is the 75 billion that's been lent as of sort of the end of March. And that will increase significantly as we go into April and May. But also it's worth noting that a significant portion of that was under the bounce back loan scheme rather than sort of CBILS So, the larger schemes were still very much secondary as far as amounts lent under that amount. So, I mean, yeah, again, in a nutshell, CBILS are still very much bubbling along. There's still a lot of uncertainty with some deals, unfortunately, but the lenders are trying to get there with regards to trying to get offers out, and we're definitely in the sort of final days of that now.
So if I mean, just to sort of summarize that in a word, then, so the deadline to get applications was the end of March. There's been April that's carried on. We've seen some offers start to come through, but from what I can see from the stats that we have internally, there's a record level of offers being made so far in May, which sounds good. But there are some of the funders there that are probably using up their allocation, which means that actually the recovery loan scheme, to a certain extent, will kind of hopefully help with some of those potential funding requirements going forward. Is that fair?
Yeah, so I think as a kind of an acknowledgement of maybe making some mistakes, there are some lenders that are looking to pre-approve anybody who doesn't or they can't get a CBILS loan out to under the recovery loan scheme. Okay. Now, obviously, that's going to be of limited comfort to those who've missed out, because, as we'll come on to, the recovery loan scheme is a bit different. It's not as beneficial as the CBILS scheme. But they are looking to try and make some amends on.
Well, I guess that's probably the next question, really. I mean, the next question is, how is the recovery loan scheme going to help, and what are the kind of the key facts around that scheme that we should be aware of?
Yeah, so the recovery loan scheme has actually been around now for a little while. It was launched at the beginning of April. Now, if you go onto the British Business Bank website, you can see the list of accredited lenders. And it's still a very, very small list. It's predominantly high street banks, and there's a few on the outside of that. Now, some of the issues around the recovery loan scheme are that obviously it doesn't offer you a interest-free period. So you do have to start repaying your interest and capital from day one, and you've also got to pay the arrangement fee. So as I said, it's not as beneficial. But largely speaking, the scheme is actually very similar to the CBILS, apart from those points. There's a couple of other bits and pieces that are different. One of the major ones is this undertaking in difficulty, which effectively just meant you needed to have a solvent balance sheet at the end of 2019. That's actually been removed under the recovery loan scheme for England, Wales, and Scotland. But that undertaking in difficulty rule was linked to rules around state aid, which was sort of an EU directive. So unfortunately, with the Northern Ireland situation, it does mean that effectively it's still in place, but that's obviously a lot more complicated, and I'm not going to go into that now, but it is sort of still there in some way.
Do you want to tell us about the kind of the key eligibility criteria then? Because
yeah, so again, very similar to the CBILS scheme. So they've got to be trading in the UK, as is listed there. You've got to be viable, not for the pandemic. You've got to be impacted. Now, that definition of impacted is positive or negative. We saw under CBILS that was not really an issue for the majority of businesses. They could demonstrate that they were impacted in some way or manner or form. And again, the interpretation of that is the same under the recovery loan scheme.
And is that a self-certification, Sam? What does that mean?
Yeah, so most lenders will come out to you and get the business to self-certify that they are eligible under the recovery loan scheme as part of their rollout. Okay. One of the key ones is that sort of final point. If a lender can offer finance on normal commercial terms without a need to make use of the scheme, they may do so. Now, this is kind of this has been interpreted by different lenders in different ways. Now, this has to be really heavily caveated, because we are talking about both accredited lenders and lenders who are going through accreditation, so haven't been fully accredited at the moment. But what we're seeing is that there's certainly an intention for some lenders to try and provide a recovery loan product. Now, the reason why that's a bit or could be interesting is that we know that the high street banks, for one, and most of the initially accredited lenders are looking at the recovery loan scheme very much like they did under the old EFG scheme. So this was the previous sort of government scheme that was existence prior to the pandemic. And what that means is that they will look to lend under their kind of core proposition, and they won't offer a recovery loan product. And it will only be if they effectively can't lend, or that they can't get. So that could be because of trading concerns in the last 2 years, or because maybe there is insufficient security. But it's only be if they can't lend that they'll then look to move it on to recovery loan. So from an applicant point of view, that does make it a little bit tricky because you don't know if you're going to end up with the recovery loan or not. So yeah, that does make it a bit harder. But as I say, there'll be some lenders that will interpret it that way, and there's a lot of lenders at the moment who are still going through accreditation who have who are intending to offer a recovery loan product. So as I say, the market will look a little bit two-sided, and it won't always be clear exactly what you're applying for, which I think will make it a little bit harder for borrowers to access.
Is there any limitations to the amount you can borrow, Sam? Or?
Yeah, so the amount you can borrow, this will come on to, I think, another question later, but the amount that you can borrow is dictated by essentially 3 key criteria. There's a maximum amount for how much groups can borrow, which is 30 million. And there's some definitions around that, and there's 10 million. Now, it's the lesser of those limits, and also then 3 other measures. Now, lenders can pick and choose which measures they use out of this, but effectively 2 of the measures are these 3 measures are the same as they were under CBILS. So the amount you can borrow, maximum amount you can borrow, is either 25% of your 2019 revenue, 2 times your annual wage bill, again, in reference to your 2019 performance, or a business's demonstrable need. Now, that last one is tricky because the only way to demonstrate that will be through a forecast. And the reason why I say that's tricky is because a lot of lenders will struggle to do a forecast-led lend, and they'll be looking at historic performance in order to prove affordability and things like that going forward. So yeah, should I cover off early stage businesses now, Damon, or do we want to come back to that later?
No, but we'll come back to that. That's fine. That's fine. I mean, is that everything you wanted to cover off in terms of the criteria and eligibility, I guess?
I mean, yeah, the rest of the criteria, as I say, is up there and is fairly clear to see. Rates are capped at 14.99%, which again, under the old CBILS scheme, there was a rate cap, but it didn't include the amount the government was paying as an arrangement fee, whereas obviously this is all how much the client will pay, so that will include that arrangement fee as well. So it does mean that some of the lenders are having to look at, certainly the ones that were charging a higher interest rate are having to look at both their arrangement fee and their interest rate in order to be compliant. Generally speaking, we're hearing from lenders in the market that the recovery loan scheme loans will be more expensive than CBILS, but there is an obligation under the scheme that the benefit of having the guarantee to the lender is clearly passed on to the business. So the rates, effectively they should be passing on a bit of a cost saving versus lending without, let's say.
It feels to me from listening to you speak, I know we speak probably every other day at the moment, but it feels to me like that it's kind of an evolving picture, and that you are well informed, but at the moment you're having to interpret some of the stuff you're being told by these funders because they're not quite clear what their proposition or product's going to look like. Is that fair?
Yeah, so a lot of lenders were expecting to be accredited. Certainly the ones that were very active in the CBILS market were expecting to be accredited throughout and certainly early stage April. We're now at the 12th of May and they still haven't been accredited. Now, that's not necessarily because there's anything nefarious going on. The BBB have been quite vocal about the fact that they're going to be taking their time with accrediting lenders this time around, and they're going to be a bit more stringent with how they go through the process. So, they were clear that that was going to happen. I heard anecdotally from a sort of smaller regional lender the other day that it took the BBB 4 weeks to come back to acknowledge their application under recovery loan scheme. So I think it just sort of goes to show where they are with this accreditation process. I would expect there to be a reasonable kind of number of lenders that would be added in the next 2, 3, 4 weeks. But there's just no real clarity on it. And when you talk to lenders, a lot of them are sending chases almost on a daily basis to the BBB to get accreditation to move forward with it. I will say as well, just finally on that, because they haven't been accredited finally, they don't know the full detail of it. A lot of these lenders will have a little bit of a delay between being accredited and opening their products live, because they'll need to actually inform everybody of their appetite.
So I guess we talk a lot about debt, we talk a lot about borrowing, we talk about CBILS and all that kind of stuff, and the recovery loan scheme coming. I think, I mean, it's fair to say, well, it's fact that a lot of businesses are now living with debt where they've not had debt before. So from your experience, I guess, what are the key things to keep in mind when you're looking at the level of debt that people have taken on, and what factors are lenders likely to sort of focus on when they're looking at additional lending? I suppose that's probably something that I'd be really interested to hear your view on.
Yeah, so a saying that's used quite a lot in lending is cash is king, or cash is key. When with business, there'll have been a lot of businesses that are now looking at debt levels that they've not seen before, or who have taken on debt for the first time. So learning to live and manage that debt, certainly through normal trading circumstances, can be challenging anyway. Also, trying to open up your business or grow your business on the back of this period does represent some further sort of challenges, specifically due to sort of working capital commitments and sort of managing that daily cash flow. So the one thing I would say about the loan schemes prior to the recovery loan scheme is that although it was available for things like asset finance, and there was an awful lot of business written under asset finance, it was also available for things like overdrafts and RCFs and things like that, which were much more kind of working capital type facilities. And there wasn't a huge
RCF for
sorry, RCF is basically a version of an overdraft. It's a revolving credit facility, so it's just another term that lenders use, but it operates slightly differently. But so there's a huge there's a lot of this lending was done as term loans, and borrowers were looking to take it over longer periods of time, 3+ years, so for 3, 4, 5, maybe even 6 years. So again, there's that piece, or there is going to be a piece to look at, which is going to be how do we manage repayment of a term debt commitment and also manage a daily cash flow obligation and situation. So I think that will be very interesting coming through to the rest of this year, really, is just how do we use the recovery loan scheme, or how can it be used, but also how can other products be used to sit alongside the recovery loan scheme to help businesses manage that cash flow position. Because again, I think you have to factor in both opening up and growing. You also have to factor in seasonality and all of those various elements that will come through to managing a business's daily cash flow, and a buffer or having that adaptable facility to then enable a business to trade through that period will be important. Obviously, if they've got the cash buffer from the loan that came through, and they've managed to retain some of that cash, that will help most businesses through this period. But it's certainly something that businesses have to look at quite closely. I think also just on that, just really playing on my own lending experience, but where you have businesses that are struggling to meet a monthly repayment commitment, even if it's just sort of an odd month here or there due to a cash flow situation, there will be a lot of scrutiny onto that cash position and what the business has spent that money on. And when I say that, one of the things that lenders will look at will be remuneration. So making sure that remuneration is both reasonable and sort of in line with previous years and things like that. So I think if a business does get into cash flow issues and to meet these debt repayments, and remuneration has been outside of kind of normal levels, let's say, then I think there'll be a lot more questions put back onto businesses. And typically those businesses are businesses that struggle to get, let's say, the added support from lenders to trade through more challenging and tighter cash flow times, because they like to see a commitment from the directors. So I mean, obviously one of the biggest things about CBILS and about the recovery loan scheme as well is the lack of personal guarantees under £250,000. So I think that there's the fact that they haven't had to, or directors haven't had to give up a personal guarantee in order to secure the funding, they'll be looking for commitment in other ways. So making sure that that cash flow position is managed. So I think it's just really a word of caution on how I would imagine these lenders will interpret and sort of potential issues as we trade out of this, versus how to, I suppose, it's better to be aware of that, I think, than to sort of be surprised by it later.
Okay, and I guess in terms of that debt burden and the repayments coming due and stuff like that, I guess transparency in the relationship with the funder is probably paramount, is it, in terms of keeping them informed?
Yeah, any sort of pre-warning, all of those things. I mean, again, a lot of the alternative finance providers aren't necessarily set up to do that, but any pre-warning you can give them, any kind of engagement you can have, always works out better in the long term. Sorry, one thing I should have said about the recovery loan scheme, which I've just reminded myself of, is, and it's a pretty important one, the recovery loan scheme is a complementary scheme to bounce back loans and CBILS and the other schemes that were there previously. If you have a bounce back loan, you don't have to refinance it. In fact, a lot of lenders won't want you to, or won't be supportive of that, because the terms under the bounce back loan will probably be significantly better than anything you get under the recovery loan scheme. So you're better off, well, in most cases, you'll probably be better off to keep your bounce back loan and then to fund a new facility on top of your recovery loan scheme. But CBILS can be used to refinance, or it can sit alongside. So it is an independent scheme of the previous schemes. You don't have the same issue with bounce back loans having to be refinanced off CBILS or things like that. But again, I know I've blown through that quite quickly, but if there's any questions on that, I'll have to color that in a bit more.
That's a really good point. I guess the other thing that comes out from hearing you speak is the fact that you've got historic stuff that's done that happened during the pandemic. As we come out of lockdown, it's probably really important to have robust forecasts. When I say robust, they don't have to be that detailed, but just showing what your cash position is going to be and what those debt repayments look like, so you can basically understand where that cash pressure is going to come from and look at alternative ways of filling that gap to a certain extent. That's the other piece I would kind of highlight, I guess.
Yeah, I would encourage businesses to talk to financial advisors, so accountants, where possible. Certainly, if they are seeing some significant growth, because if your business is one which has, let's say, it absorbs cash or needs a lot of cash to grow, then there are things that can be done to then help free up some of that cash to enable you to grow. But also, if you're cash positive and you generate a lot of cash through growth, so again, these are businesses like predominantly hospitality type businesses that will take payments and receive cash very quickly, but then have to make payments to their own suppliers over credit terms. What will happen to those businesses is actually they'll be very cash positive throughout a growth scenario and as they come out of this. But again, where that cash is being spent and how it's being spent, it can unwind quite quickly if fortunes turn again. So I think it's just making sure that you do understand your own kind of cash dynamics, let's say within your own business, and as you say, have some sort of insight into how you might trade through the rest of this year.
Okay, just to summarise where we've got to, then we've got the CBILS scheme closed, but still companies are getting offers, and they've got an opportunity to still get those offers out for the next month and draw down in June. So that's good news. Recovery loan scheme is coming. High street banks and a few people are already participating, but others are coming in, and you're kind of all over that in terms of communicating with them and getting updates and trying to kind of like keep everyone informed in Swoop, and also for the customers that register with Swoop. And also that whole thing about looking at the future cash flow, looking at the repayments as they fall due, to make sure that level of unprecedented debt is managed in a sophisticated and sensible way is really, really important. I guess if you look across the marketplace, there must have been some kind of innovation that's happened over the last 12 months, and particularly around, I know that there's a lot of capital that wants to come and invest in UK SMEs to get this bounce back, to get involved in this growth. What are you seeing in the market in terms of product innovation?
Yeah, so I mean, a key thing to remember is, I suppose, again, in the alternative finance space, the biggest growth period for that, or the biggest kind of boom and establishment of that in the UK was following the 2008 financial crash. So it was banks effectively shutting shop, not looking to lend. So alternative finance needed to come in and fill the gap. To a certain extent, obviously, banks are still quite restricted on what they can and will do, because they've lent a significant amount. So a majority of that in fact, all of that bounce back loan kind of fund has come from the high street banks. So they are very highly lent. They are going to be selective on what they will do, including under the recovery loan scheme. In fact, most of them are only lending to their own existing clients. So there is a real limitation on that liquidity. But then flip side to the existing alternative funding space, a lot of those lenders are quite heavily lent under CBILS, and therefore they may face liquidity challenges, and certainly the more established ones are going to be looking to how they continue to trade out of this. What I would say though is that thanks to the bounce back loan scheme and the amount linked by the banks, a lot of other lenders in this space hugely underlent to what they would be normally expecting to lend. So a lot of the ones that operate in that sort of naught to £50,000 space. So those lenders actually have funds who are just seeing the returns that they were expecting to see, and are therefore looking to diversify and looking to allocate funds around the alternative finance space. So again, we're seeing a bit of a shuffle, and we will see this throughout the year and probably into next as well, where some lenders that were less active last year are potentially looking to become very active this year, and vice versa. So there is still a lot of liquidity washing around, as you said, Damon. There's interest in investing in kind of our growth out of this, but it's just where that liquidity is going to end up and where it's going to be assigned is going to be an interesting thing over the next sort of year or so.
So one of the sectors that we talk about a lot is kind of like e-commerce platforms that seem to have kind of flourished on the back of COVID and the pandemic. What kind of funding opportunities are there for them? I know this is one of your favourite topics at the moment. So.
It is. I mean, e-commerce funding is a really interesting one. It's sort of started to come out more as its own type of funding, I would say, in the last year or so. It's effectively a form of revenue funding. So it's less concerned about profitability or age of a business, and it's more concerned about what the revenue line coming through is, but also, I suppose, what the business model is and what integrations they can get to get a greater view over those income streams. What they do is they effectively take a cut or a factor rate of any kind of future. They take a cut of any future repayments. So they take a cut of any future income that comes through to meet their debt repayments, and they charge a factor rate, which means that if, let's say, you borrow £100,000, if their factor rate is 1.2, you pay back £120,000. Simple as that. But it's less related to how long it takes to repay, because obviously that will be linked to both the amount the amount of future revenue they take and the amount of time effectively it takes you to build up that revenue to repay them. So it's a bit, I mean, I know that was a bit of a brief explanation, but this I suppose this market, this e-commerce space, there are more specialist lenders that are coming into it, and these specialist lenders are, I suppose, recognizing that these income streams are robust and that there's good visibility over them, and therefore the rates for these types of facilities are starting to drop as well. So we've got more and more new entrants into that space, and the rates in that space are getting better and better and more competitive depending on the income models. And really that income model can apply to SaaS businesses. It can be sort of it's really any business that receives a payment through an online platform or really, I mean, one of them described it as any business that has a website, but I think you've also got to be generating revenue from that website.
It's also linked to the return on investment on marketing spend and things like that as well. They can predict the revenue based on previous returns and marketing spend, can't they? Which is a good thing.
So a lot of it is really designed for either stock, marketing spend, or general user acquisition cost. So that's really kind of the level it's at. I mean, it's hard to generate huge amounts of sum from it because, as I said, it's sort of typically around about a month's worth of revenue. But these models are coming in, and they're coming into the fore. And most importantly, I think probably to the majority of the people on this call, you don't have to give a guarantee for that type of product. So I think it's just a good example, I think, more than anything, of some of the innovation that's continuing to happen. It doesn't make it that easy, personally, I feel, for borrowers, because it's yet another product or yet another way of doing something. But I suppose in essence, that's why we're here. We can kind of talk you through it. We can talk you through what the options are, what they look like, so you can understand them a bit better.
So I know I'm going off piece slightly here a little bit, but the other thing that comes up a lot in our conversations, which I think hopefully we be fairly valuable insight, is the fact there are some funders that take more heed to current trading performance and the position in the bank. Is that fair? Rather than historic financial accounts, is that?
Yeah, so I suppose traditional bank lending, and we still have an awful lot of alternative finance providers who lend under this, will be looking at effectively a profit and loss based affordability test. So they'll basically be saying, are you making enough profit to repay our debt? And they'll use that profit as a pseudo cash measure. Whereas a lot of the newer lenders in the marketplace will be looking at effectively open banking integrations. They'll be looking at your bank account statements and things like that, and they'll be trying to ascertain your real kind of cash performance over the last year, and certainly cash performance more recently, to then say, is there surplus cash basically available to service debt? So it does make it tricky to understand which lenders are assessing affordability on which model, and therefore which one might better suit you. But again, coming out of this, looking at the at the recovery loan scheme in particular, those lenders will be typically looking at a more profitability based assessment, because they need to demonstrate, well, they're just more likely to be traditional lenders, let's say, than these sort of open banking integration led, okay, and some of these alternative models that are out there.
That's great. Look, I know we've talked a lot, and there's one final thing I want to ask, and I think we've got a couple of questions just to cover off, but if anyone's got any questions, please share. But how can Swoop help accountants, advisors, businesses keep on top of all this stuff? Because it sounds relatively complex, but it also sounds like it's evolving kind of. It's pretty fluid, right? I mean, that's the point. So how can Swoop help?
Yeah, it's very current. So things can shift tomorrow. Let's put it that way. So I think really it's just about, the key way that we can keep you up to date and keep you abreast of what's going on is register, make sure that you're kind of linked up onto us, sign up for the marketing and newsletter kind of communications. We've got a very active marketing team that are very keen to get information out to our user base and to keep people updated with what's going on. We've got a team of experts that sit here, funding experts that sit within Swoop, who are actual people, we aren't just technology, who I suppose can give you an update on kind of where we are with certain things and what options are available to you. So I think there's that. Ultimately, we'll try and keep you as updated as we can as information comes out, to give you an idea of what the kind of funding landscape looks like and what options might be available.
But in the meantime as well, if you're a commercially viable business, there are funding solutions there for you that can be done in the interim. You haven't got to wait for the recovery loan scheme. I guess that's the other point, isn't it?
Yeah, sorry. So there are a couple of providers that have looked to, let's say, fill the gap a little bit. So they will offer you terms and a facility now, and effectively they'll just say that you don't have to pay any breakage fees or any early repayment costs if you're refinancing out to a recovery loan scheme loan or something like that. So there's a couple which are looking to be supportive. There'll still be arrangement fees to pay and other bits and pieces to pay. So I'm not saying it's the best idea for everyone, but if you are looking at that cash position, you need some cash sooner rather than later, then that may be an option for you. But as I say, I'm not saying it's right for everyone.
Okay, and I guess the other thing is that as debt falls due for repayment, there are opportunities on Swoop to look for things where you can save money, for example, on your bank current account or with your utilities, energy, insurance costs, those kind of things, because it's not just about borrowing money, it's about repaying it. So looking at those everyday items of expenditure that sometimes get forgotten, actually there are some substantial savings to be had there, particularly around opening new bank accounts and using those bank accounts for maybe expensive transactions and things like that. We shouldn't forget that. Look, I'm really conscious of time. You mentioned earlier early stage businesses, and particularly the ones that have formed in the last sort of 12, 18 months. Are they eligible for a recovery loan scheme? What can we do for them?
So there's always a bit of a juxtaposition. So under the scheme, yes, you are eligible. However, I think it's really important to point out that amount you can borrow limitation under the scheme, which obviously refers to 2019 performance. So if you're a newly formed business, there is only one criteria you can fall under to assess how much you can borrow under the scheme, and that's your forward look. Now, most alternative finance providers are not very good. Some won't do it, and some will, but aren't very good at lending against purely forecast-led kind of projections. It does make it very tricky to assess things like affordability and track record of performance and other bits and pieces like that, which from a credit perspective makes it challenging. What the BBB were very clear to say, which I think also tells you about, some of the undercurrent of the message, they were very, very keen to point out the startup loan scheme, which has always been there and will continue to be there, which is a scheme that allows newer businesses to borrow £25,000 per director. And it's a government-backed scheme. It's very reasonable as far as pricing. It can be extremely painful to get and to actually to obtain because of the process, because it's a kind of government scheme, so it's not necessarily commercially facing as far as kind of speed of delivery and ease of use and things like that. But they were very keen to point that out as an option for, or maybe a more appropriate option for early stage businesses. So I think this is where it's really clear to point out that the scheme has rules, and the rules are kind of available now, but lenders are still obligated to lend under their own existing appetite. And depending on how they're funded and what their own appetite is, again, under CBILS, the majority of lenders were looking for businesses that were at least 3 years old, and that was their standard terms. So I think we will see that happen again. Hopefully we will see a couple of lenders out there, because we did see a couple towards the end of the CBILS scheme who were willing to look at businesses that were less than 3 years old, so maybe even only a year or two, too old. But again, I think it's going to be a much smaller market that's available to borrowers in that area. I think in the short term, if you are an early stage business and you do already bank with a high street bank, it may be worth talking to them. However, I would strongly suspect that you would need at least 12 months worth of trading in order for them to consider you, take you forward. Banks have been very, banks typically are quite closed off with what they reveal about their kind of own criteria and their own credit appetite, because they like to tell everybody that they'll do everything. However, I think we all know that that's not strictly true, and that they'll do what they want to do within that area. And I say that in the full knowledge that I used to be in a number of banks. So I think,
it's an important point there. We the one thing that you touched on earlier, part of your role is to make sure that we increase that level of certainty throughout this process. So making sure that when a customer comes to us, we not only match them to the right funder, but also we curate the information and package of that information in a way that it tells the accurate story of the business, so that the chances of a successful application being approved are maximised. That's really, really important. And it is those years of experience of working in banks that, sometimes we joke about, oh, well, we used to work in credit, we used to work in banks, but actually that experience has held up well for us in the last sort of 12 months in particular. And I remember when COVID did kick off and we had the coronavirus hotline and we were taking calls every day, you and I in particular were the ones that were spending time doing deal forums with customers, talking about their opportunities and options and all those kind of things. It was really, really important. I'm just conscious of time. So just another question, Sam. Can the recovery loan scheme be used to fund construction or to buy land for development?
I mean, again, technically the scheme can be used for any appropriate business use. So yes, you should be able to use it for that. Again, it just comes down to whether or not you've got a lender that is comfortable with lending under those for that purpose. And we did see under CBILS there were a couple of lenders that were accredited, certainly towards the mid and end, who would look at or was happy to fund construction and other bits and pieces like that. But again, I think it's going to be all down to which lenders are accredited and what their appetite for it is. And again, especially in that area, we know that the high street banks are not, let's say, the most active in that market. So you are again looking at the alternative finance providers who are active in that market and who are doing things, and we're waiting for them to be accredited to then open up some options for you.
Okay, and another question is, why are some lenders offering this and others aren't? I think you've probably covered that off, haven't you, to a certain extent? But
yeah, it's I mean, predominantly it's down to either operational or funding restriction. So, and that could just be to the fact that it's going to cost them too much to roll out the scheme because they're not operationally set up to be able to do it, or and some lenders are just quite frankly choosing not to do it because they're looking to support their own clients under different their own kind of existing policies. They don't see the need to effectively add a new product onto their kind of offering. So yeah, it does vary from lender to lender as to why they may or may not want to do it. Certainly in asset finance market, we saw that there were some real winners who didn't sign up to the government schemes versus some lenders that signed up to the scheme and also did extremely well. So I think it's a trade-off. It's down to each individual lender as to whether or not they want to sign up and they want to join. As we know, the main, the big high street banks weren't really given a choice. But I think if you're outside of that, you are given a choice as to whether or not it's appropriate or whether or not you feel it's appropriate for you. The problem with that is obviously then your customers end up paying the price. But this is why we try to make sure that there's plenty of availability and liquidity in the wider market to help support you. I should say, again, unlike the bounce back loan scheme, obviously you will be able to access this via a number of lenders, so it won't be restricted like the bounce back loan scheme was. It will be much more like the CBILS scheme, whereby there will be a market available to you for you to approach.
Okay, so there's one more question I've got that's come up, and there's a couple of things that come in the Q&A, which I'll cover off in a minute. I guess you mentioned earlier that you have to be impacted by the coronavirus. Somebody's asked that can you apply if you haven't been affected by the coronavirus? I guess the answer is not for the recovery loan scheme, but you can apply for other types.
Yeah, so it's a really tricky one because it is a self, it's a self certification. So the way most lenders are looking at it is that as long as you're happy to self-certify that you have been impacted in some way or manner, then you will qualify. Now, justifying that to yourself how you've been impacted, again, it can be positive, it can be negative. It could be that there's a whole new market or opportunity that's opened up for you, which is why you've kind of taken the decisions that you've taken. But I think it's a really, really tricky one, because I certainly wouldn't want to advise someone to do or just even comment someone to do something that they didn't feel comfortable doing. It's up to you to decide to yourself whether or not you feel that you have been impacted in some way, manner or form. And obviously that's got to be communicatable. You've got to be able to make that clear to a lender if they ask a question. Okay, well, how?
I mean, I know that's a tricky question. I know it's a tricky question to ask. I guess the key thing there is to think about what actually do you need the loan for, or the funding for, and if it relates to anything that has either been positively impacted or negatively impacted by COVID, then I guess there's a justification there, but you do have to self-certify. I mean, I want to take on 2 new members of staff because my turnover is growing. Why is your turnover growing? It's growing because more people are coming online and purchasing from me because of COVID, or those kind of things. It's that kind of things that people have to look at, I guess. Tony, you've asked a question around your business in terms of being an EdTech founder and how possibly could we help you, and what's the best bank for startups and things like that. I think to answer that question, also you probably need to understand a bit more about your business, and so really happy if you wanted to sort of drop me an email at damon@swoopfunding.com or Sam Lockwood at swoopfunding.com. For me, it's just my first name, but we have 2 or 3 Sams work for us, so it's Sam Lockwood at swoopfunding.com, and we'll happily have a conversation with you or put you in terms with one of our funding experts. And then Chris, you've asked a question around if an application is rejected, will this impact on the credit profile? I guess you'll meet. You'll kind of talk about the credit score and the credit agencies. Sam, do you want to pick that up, because I know that we talk about this quite a lot.
Yeah, so most lending applications will require some sort of personal credit search attached to them. So we are and were very conscious of ensuring that you're only put forward and applying for loans that you have a reasonable chance of securing, and also that we ask all our clients when they come to us, have you applied elsewhere, have you applied via another broker, because we need to understand where you're at with that. Applying numerous times to a business has less of an impact, but applying numerous times and obviously consenting to lots of personal searches, can have an impact on your personal credit score, which obviously then can become a self-fulfilling prophecy of getting an increasingly declining personal credit score, which means that it's harder and harder to obtain finance elsewhere. So yes, I'd always be wary of making too many applications. I don't think 2 or 3 applications aren't going to really cause you a huge issue. But I think if you've already got credit concerns, or if your personal credit or your business credit isn't really quite up to scratch, I mean, one of the things that we try to do is we do a business credit search, where when you engage with us and you decide that you want to take forward a proposition or a request, and we do that so that we can basically get an idea of where the business currently is sitting and whether or not it's likely to be approved, so we can sort of try and preempt that issue of applications that aren't likely to be successful. So I think if you get rejected, that in itself doesn't impact your credit score at all. It's more just the process and the searches that they do as part of that process that can impact. But as I say, there's less impact on the business. You can have multiple searches on a business, and it has less impact on that score than versus a personal.
Where the business credit searches, the number of business credit searches are done, sometimes does impact, is if you are the underwriter looking at the file and you can see that there have been numerous searches done in a short period of time. So for example, if people were to go to multiple brokers and they approach multiple funders, that can sometimes, you've got to be a brave person sat in a credit team to approve a deal where you can see 4 or 5 other funders have looked at it and still haven't made an offer. That's quite important. But I think the other thing you can do, we have some partnerships where we can help businesses understand their credit score and what they can do to influence that credit score. For example, filing their accounts on time, paying their suppliers on time. Those kind of things will really, really impact on a business credit score. When it comes to personal credit scores, which I think is another question we've had here, so the business credit score can be really, really strong, but you may have a fairly weak personal credit score. Then you should talk to the people that do personal credit scores and find out what your credit score is and what you can do to improve it. That area is really down for you as an individual to understand. And they will share with you your credit score. They'll share with you some insight around it and also how you can improve it as well. But I think those 2 things are really, really important because. Go on, sorry.
I was just saying, well, most personal credit reference agencies will give you your own report for free, and it won't impact your own score to get your own detail. And a lot of them now are offering services to try and help improve your own personal score and things like that. It's not an area we get involved in because it's your own personal credit score, but we can do a bit more on the business credit score and sort of talk you through some options around that as well.
Yeah, and I think on the business credit score side of things, they are really, really important to understand what drives those, because they basically help a funder assess which risk bucket you are in. One of the things we haven't touched on is there are funders out there that will fund a wider range of credit scores, and there are some that will just fund. I like to look at it as a A to an E. An A is a good credit, an E is probably not going to survive for very long. And there are some funders that will just do A's, some will do B's, some will do A, B's, and C's. So understanding how that credit score impacts on which bucket you're in is also relative to the price of that risk in terms of what you're likely to be charged. So having a good understanding of that as a business owner, I think, is really, really important. And we do partner with a couple of firms that will really help you understand your credit score and what you can do to improve it, and also how it's likely to be perceived as well. So it was a really, really good questions. I'm conscious of time, Sam, and I know that you're really busy because we've got lots of stuff to get done. I think a couple of things I'd really like to say. I mean, the first thing is that was really insightful from my point of view. I know we talk every day, but I learned some stuff there, so that was really great. Thank you very much. I think the other thing I'd like to comment on is that a lot of people stayed on for the whole duration of that, which is really, really great. So well done. Thank you very much for your time, and also thank you to everybody who spent the time with us today. Hopefully we'll see you again. Contact details and everything I guess will be sent out later, but if you want to get in touch, my email is damon@swoopfunding.com, and happily point you in the right direction. Thank you for your time, and wish you a very pleasant rest of the day. Thank you very much.
Brilliant. Thank you, everyone.
Thank you.